2020 was one of, if not the craziest years in stock market history. Now lots of people are talking about a potential stock market crash on the horizon, and in this video I want to talk about the truth about what could be coming in the stock market. What's up everybody, I am Jasprit Singh from the MinorityMindset.com, where money minds rethink rich. In 2020, we saw the stock market go from breaking record highs to breaking lows at record speeds to breaking highs again. That was the quickest boom, crash, and boom cycle we have ever seen. Now you have a growing number of people that are pointing at things like the business bankruptcies that have happened and that are happening, the unemployment numbers, potential lockdowns, and the money printing, saying that these things could help trigger a stock market crash. But like with everything else, it's not so simple, and if you really want to understand what's going on and what might be coming, you have to start by understanding the broader picture, and you have to start by smashing that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. If we take a step back and look at how the stock market has grown, back in 2007, the stock market peaked at just below 14,000 points. And when I talk about the stock market, I'm talking about the Dow Jones. So in 2007, the Dow Jones peaked at right around 14,000 points, and then in 2008, as we all know, the stock market crashed. In 2008 and 2009, the stock market bottomed out at right around 7,500 points. So almost a 50% drop. After 2009, that's when we saw the stock market start to recover, and it recovered until about 2012 and into early 2013. In late 2012 and early 2013, that's when the stock market went back to around 14,000 points, hitting its early 2007 high. Now from 2013 until 2019, the stock market just kept going up from 14,000 points to much higher because the economy kept growing and the stock market naturally kept going with it. Then in 2019, things became very interesting because in 2019, the economy started to slow down and the stock market was kind of getting a little worried because people were saying that if the economy is slowing down, then the stock market's going to come down. So that's when people started talking about a potential stock market crash. But that's when in 2019, interest rates were cut. So typically, interest rates are only cut when you're in a recession because lower interest rates stimulate the economy because now it's cheaper for people to go out and borrow money. And when it's cheaper for people to go out and borrow money, you're more likely to buy a home, you're more likely to spend money, and businesses can borrow money for cheaper and then they can invest this money into their business. So interest rates were cut in 2019, not during a recession though, but in a very growing economy. If you remember, back in 2019, there was tons of headlines talking about how the United States is in the strongest economy ever, and in the strongest economy ever, we were cutting interest rates, which is something you typically do when you're in a recession. So the reason we were cutting interest rates is because the economy was slowing down, people were getting worried about what was going to happen, and that kind of kept the stock market going up even more. This brings us to 2020, which I'm going to put on its own line because 2020 was a crazy year and I think it definitely needs its own diagram. So in January, February of 2020, we were breaking new highs in the stock market, and in February of 2020, the stock market hit right around 29,000 points for the first time in history. But then, as we all know, in February, that's when the pandemic came and it shut everything down. And then in March, people panicked. Everybody was like, what is going on? Because we have never experienced, or at least I have never experienced, an economic shutdown like this before. And everybody on Wall Street did not know what to expect. And so people were panicking, they were selling their stocks, and we saw the fastest stock market sell-off in history, and we saw the fastest bear market in history. So we went from 29,000 points in February to right around 19,000 points in March, just 1 month later. Then in April, May, this is when things started to turn around because people started to kind of understand this virus a little bit more. People started to understand this pandemic a little bit more, and the economy started to open up a little bit. So that's when money started to flow back into the market. And so now we saw the stock market start to go up. So in May, June, July, August, September, October, we kept seeing the stock market go up. I mean, there were some months in the middle where the stock market came down, but in general, the stock market kept going up from 19,000 points higher. Then going into November and December, so this is towards the end of 2020. I'm going to talk about 2021 in just a second. So we'll talk about end 2020. What we saw happen is the stock market reached new highs. So in December, we saw the stock market break 29,000 and hit 30,000 points for the first time in history in December of 2020. So February, we broke a new high. March, we saw the fastest stock market sell-off in history. Then in March to December of 2020, we saw one of the fastest stock market rallies in history where we broke a new high. Some of the things that contributed to that were low interest rates. Remember how we talked about how interest rates were cut in 2019? Well, in March, interest rates were also cut again. We saw interest rates go to the lowest levels ever. That's why you hear people talking about these low mortgage rates, because we have never seen interest rates this low. So we saw interest rates get slashed to insanely low levels in March. And we also saw a lot of stimulus happen. So we saw people getting stimulus checks. We saw businesses getting bailed out. And we also saw a bailout in the stock market because for the first time in history, the Federal Reserve Bank started buying corporate bond ETFs. The Federal Reserve Bank kept pumping money into the market. And so we have seen an insane amount of stimulus, not just for people, not just for businesses, but also the stock market. And so this kind of pushed the stock market up to brand new highs, which is why towards the end of 2020, we saw the stock market break 30,000 points. And now the question is, what is next in 2021? The first thing we can look at is the money supply or cash that's going into the stock market, because on a very basic level, at the end of the day, the stock market and stock prices are determined by supply and demand. If you have a ton of people that own stocks, but nobody that wants to buy a stock, if these people try to sell the stock, well, nobody's going to be buying it. And so now the people who are selling stocks are going to have to cut their prices, and that's going to push stock prices lower because nobody wants to buy a stock. That's what happened in March because everybody was worried about our economy. Everybody thought the economy was going to collapse, so nobody was buying stocks, and so the stock market collapsed. So if you have no buyers and a lot of people who are selling, this makes stock prices go down. But if you have a ton of people that want to buy stocks and not a lot of people that are selling, this pushes stock prices higher. So you have to look at the kind of money supply that's going into the market and how much money is going out of the market to really kind of understand what's going on. Well, in this early time, March, April, May, June, what we saw happen was during this time, we saw a ton of money sitting on the sidelines. So during this time, we had a ton of money leave the stock market, and we saw some of the biggest piles of cash held by investors in cash, not in the stock market. So if your money is in cash, not in the stock market, that means you have less money going into the stock market. During this time, we saw a lot of retail traders, so people who are trading off of Robinhood and Webull and apps like that. We saw a lot of retail traders go into the market, but we saw a lot of bigger investors who have a lot of cash pulling their money out. And so during this time, people were scared and there was not a lot of money in the market. But towards the end of 2020, we saw the complete opposite happen. We saw now, towards the end of 2020, a record influx of cash into the market, and now we actually have less money sitting on the sidelines in the end of 21 than we did before this whole pandemic started. So during this March, April, May time, we saw a record amount of cash leave the stock market and sit on the sidelines. Now towards the end of 2020, October, November, December, we saw a record amount of cash enter the market, where now there's less cash sitting on the sidelines towards the end of 2020 than there was before this whole pandemic even started. Now before I get into what triggers could cause a stock market crash and what might be coming, I do got to give credit where credit's due, because AK made a great YouTube video where he talked about how this cash inflow and outflow affect stock prices and how earnings and buybacks could also affect stock prices. If you haven't seen that video, I will link it for you in the description below. There's 3 things that you need to look at that I'm going to be talking about. First is understanding stock market pricing and what affects the stock market prices. Second, understanding stock values, because the value of a stock doesn't always correlate with its price. And third, understanding the triggers that could really affect the stock market. Starting with pricing of the stock market, you have to remember that when people buy stocks, they're not buying stocks based off of what they think is going to happen today. They buy stocks based off of what they think is going to happen in the future. So the stock market kind of prices in the future economic expectations. What you don't want to get confused is confusing the stock market with the economy, because the stock market is not the economy. The economy is what's going on in the world right now. The economy is whether you have a paycheck, whether your neighbor has a paycheck. What is going on in the economy is the economy. The stock market is what people think is going to happen in the economy in the future. The way Warren Buffett explains it is, in the short term, the stock market is a voting machine, and in the long term, the stock market is a weighing machine. Essentially, in the short term, the stock market can be very emotional because people can start panicking and they'll start selling, and then they can get really excited and they'll start buying, and this can push the stock market up or down. We've talked about this on our YouTube channel, which is why if you haven't subscribed yet, make sure you do that. But over the long run, the stock market tends to rationalize. If we focus just about pricing, like I talked about earlier, you have to look at supply and demand, and you have to look at how much money is in the market. Money in market. Because if there's no money going into the market, stock prices are going to go down. But if you have a ton of money going in the market, at least in the short term, you're going to see stock prices go up. And so you have to look at the factors that affect the money in the market. Every financial analyst and money manager will tell you that the thing that affects the money in the market is how well the economy and companies are doing, because if companies are doing really well, it's going to attract more people to invest in the market. But I'm going to talk about this when I talk about valuations. In this section, I really want to just talk about what affects the money in the market. If people have more disposable cash, what we've seen happen now is people are more likely to invest in the stock market because of the growth of digital brokerages. So a couple things that affect this are digital brokerages and cash that people have. So if and when people get more stimulus checks, there's a good chance that some of this money is going to go into the market. Second thing to look at is regulations, because when the 401k was created, guess what? That pushed a ton of money into the market, because now it created a system where employers and employees can invest their money into the market, and your money gets tied into the market, because when you invest in a 401k, you're not taking that money out until it's time for you to retire. So if we see more regulations that incentivize people to invest in a 401k or to create more investments like that, then that could put more money in the market. The next thing you have to look at are interest rates, because this recession isn't over, and there's a very good chance we could see interest rates drop even more. Now, as interest rates come down, it makes borrowing money cheaper, and now institutions can borrow more money, and where will they throw it? Back into the market. So if interest rates come down, money supply goes up, and if the money supply goes up, chances are we're going to see more money go in the market. And the most interesting one of these things are probably buybacks, because the way buybacks work, if you remember in 2020, there was a lot of negative kind of publicity around stock buybacks, is where a company has a ton of cash in their bank account, and now what they do with this cash is they use this cash to buy their own stock. So a company is deploying cash into the market to buy their own stock, and this essentially acts like a big buyer of a company, and this pushes stock prices higher. Well, in 2020, after this whole pandemic started, there was a really kind of bad PR around buybacks, because naturally a lot of companies wasted a lot of money on buybacks and then didn't have any money to take care of themselves when this pandemic happened, and so taxpayers had to come in and bail out these companies, and so you saw almost no buybacks happen in 2020. Well, after that, lots of companies got very precautious, and they started saving a lot of cash, because nobody knows what's going to happen in this pandemic and everybody was worried, and so companies started saving a lot of cash. And they also weren't doing any buybacks in 2020 because of all the negative press around buybacks. But if we go into 2021 and this pandemic goes away and this kind of risk factor goes away, then what we might see is that these companies have a ton of cash that they're not using, and this cash could now be used as buybacks, because we didn't see that many buybacks happen in 2020, so 2021 could be the year of buybacks if corporations have a lot of cash that they're now ready to deploy into the stock prices, which would make stock prices go up even more. Second, let's take a look at valuations, because you might have heard people talk about how this stock market that we're seeing is the most overvalued stock market in history. All valuations really mean is how much this company is selling for. So if you're a company and you made $100,000 in profit, the question is, if you were to sell your company today, how much would somebody be willing to pay for that company? If you made $100,000, maybe somebody's willing to pay $1 million, or maybe they're willing to pay $10 million. The question is, what is a fair valuation? Now, there's not one single right or wrong answer here, because some industries are going to have much higher valuations than others. Like if you are a restaurant, then maybe it's 15 to 18 times earnings. That's kind of a general range. If you are a tech company, then it's going to be many times more than that. I mean, we're seeing some tech companies that are selling for 100 times earnings. So if you make $1 in profit, you're going to sell for $100. If you make $1 million in profit, you're going to sell for $100 million. This valuation debate gets really heated because lots of people say it doesn't make sense for a company to be valued at 100 times earnings, especially now because some tech companies are being valued at 1,000 times earnings. So if you make $1 million, you're not selling for $100 million, you're selling for $1 billion. And so some people say these valuations just don't make any sense. Well, this is where you have to kind kind of come in and be a judge and decide what's a fair valuation. The reason people are saying that this is the most expensive stock market in history is because valuations are higher than we have ever seen before. Now, the one caveat that you really need to understand about that is that right now, the reason why valuations are higher than kind of what we saw in February is because right now, a lot of companies are not making the money that they were back in January or February or back in 2019 because of economic shutdowns, because of slowdowns, because of this pandemic. So based off of today's profits, yeah, the valuations are really high because a lot of companies are not making any money. What people are doing is they're valuing companies today based off of how much money they think the company's going to make in the future, because a lot of people, especially investors, have their eye on the future where the economy will open back up and this pandemic will be gone. And so they're valuing companies based off of what it will be post-pandemic. So if 2021 and 2022 come and the economy opens back up and companies are making a ton of money, then these valuations might come down because now companies are making profits, assuming stock prices don't go up significantly, and then valuations might go back to normal levels. But if the pandemic slows down and the economy doesn't recover, and now companies have these super high valuations, but companies aren't making any money, now that's going to create some issues because you have super high valuations for companies that are not making any money, and the future is going to look more bleak then, and that's where you could see a correction. And that's why you have to look at number 3, what could cause a stock market crash? What are the potential triggers for this? Now, just so we're all on the same page, typically when we talk about a stock market crash, we're talking about a 20% drop off of a stock's highs. Anything less than 20% and it's considered more of a correction, and more of 20% and that's considered more of a crash. There's 2 ways that I want to analyze this. One from an emotional level, because as we all know, the stock market is emotional, and second, from a more fundamental level. So looking at the economy, looking at jobs, looking at the value of our dollar. What we saw happen back in March of 2020 was an emotional crash because everybody was scared, everybody started panicking, and people started panic selling. Now, if lockdowns come back and we see this pandemic get worse, we could see more emotional selling, but chances are we're not going to see a March type of stock market crash emotionally because, well, we've already experienced it. That kind of like initial shock factor is gone because we've been living through this pandemic and we kind of know what's going on. So yeah, I mean, if things get worse than expected, then we're going to see an emotional sell-off. But we're talking about like an emotional crash we saw back in March. I don't think it's going to happen. Now, I could be wrong, but I just don't think we're going to see it happen because people are more familiar with what's going on in the market and that initial shock factor isn't there. The second thing we want to look at is what AK calls a sentimental indicator, because back in March, and what we see happen time and time again, is anytime all the news headlines are bearish, meaning pointing downwards, then typically that means it's a good time to buy. And if you see all the headlines saying the stock market cannot go down, then that's typically a good time to sell because that might mean the stock market will be coming down because everybody thinks the stock market is going to go up. So it's kind of like a contrarian view to the media, because what we've seen happen is when the media says that the world is ending, that's a good time to buy stocks. And when the media says the stock market cannot be stopped, that's usually a good time to sell stocks at the top. When all the headlines said that the economy is over and the stock market's done for, that's when we had all the cash on the sidelines and the stock prices were down. So that was a good bullish sign, meaning the stock market would go up because now there's a lot of cash on the sidelines and there's a lot of potential in the stock market. Now what we're looking for is if all the media says that the stock market is going up, meaning bullish stuff, then that means that all the extra cash is deployed in the market and now there's no excess cash waiting to be put in the market, because if there's no more cash going in the market, then that kind of limits the upside in the stock market. At the time when we're recording this video, we're not there yet. We're seeing kind of a blend of good and bad headlines, which means there's probably more cash sitting on the sidelines that still has not been deployed. What you want to pay attention to is once everybody starts talking about how the stock market cannot be stopped and the stock market's going to go up forever, that's when typically what that means is there's a lot of cash that's now in the market and there's not a lot of extra cash outside of the market, and you may want to kind of use that as a signal that the stock market might be hitting highs and could be getting ready for a correction. If we look at this from a fundamental level, now we're talking about how strong is the economy and how strong is the underlying company, because at the end of the day, when you buy stocks, you're not just investing in stocks, you're investing in a company. You're getting ownership in an actual company. And so if the underlying company that you're investing in isn't making any money, then that eventually is going to cause fundamental issues, and that would cause stock prices to come down. So this is where we have to look at the strength of the economy, because we still have a lot of Americans out of a job. We still have a lot of businesses that are out of business, and we still have a lot of room to grow in the economy. So if the economy does not recover the way that a lot of people think it's going to recover after this pandemic, that's going to cause fundamental issues, kind of like what we talked about in the valuation section. And that could cause stock prices to come down because if people don't have jobs, then they don't have money to spend. If they don't have money to spend, they don't have money to shop on Amazon and a Lululemon and an Apple. And if Amazon and Lululemon and Apple are not making money, then we could see the profits go down. If the profits go down, eventually that's going to hurt the fundamental part of the stock market, and that could cause stock prices to come down. The thing here is people are very hopeful because now we have this vaccine coming and we have this pandemic fatigue where people just want to go out and live their lives and spend money, and we have this new stimulus plan. The risk, of course, is nobody has a crystal ball and we don't know what things are actually going to be like once this pandemic actually goes away. And so if things are worse than what people expect, then that could cause a correction, maybe even a crash in the stock market. Now, as we're talking about fundamentals, you also need to understand how the value of our dollar plays a part in the stock market, because 2020 was the year of money printing, where the government printed more money than ever. A lot of this money went into the stock market, but what happens when you print all this money is the value of our dollars go down. Now, as the value of our dollars go down, the price of things go up. This is what inflation is. And so you have to kind of wonder how this inflation and how this money printing and how the devaluation of our dollar is going to affect the stock market in the long term. This is the reason why some people like Ron Paul are calling this the biggest financial bubble in history, because we have never seen money printing happen like this before. We're not going to see the real inflation and effects of all this money printing until the economy recovers, because right now we're actually in a deflationary economy rather than an inflationary economy. Now, I know this is where things get a little bit confusing, but just stick with me. So a deflationary economy is what happens when you see an economy slow down, because as an economy slows down, people lose their jobs. If people lose their jobs, then they don't have an income. If you don't have an income, you don't qualify for more loans or more credit. If you don't qualify for more loans, you are less creditworthy, which means now there's less money being used in the market, because we live in a credit-based economy. People don't spend money based off of how much money they have in their bank account. They spend money based off of how much credit and how many loans they can get. And so if people cannot qualify for loans, they cannot qualify for credit, there's a lot less cash in our economic system. So if there's less cash in the economic system and we print more money, we're actually just trying to fight off deflation because there's less cash in the system. We have the same amount of cash, we just don't have as much credit. In the economic system, nobody cares if you're spending cash or credit, because it's the same way. If you go to the store and you spend $100, the store owner doesn't care if this is your cash or if this is a loan you got from somewhere else, right? So cash and credit work the same in the economic system. And so right now, when you're in a slowing economy, you're in a deflationary system because there's less credit available, which means there's less cash floating around. So as more money is printed, this is fighting off deflation rather than creating more inflation, because we're trying to make up for this lower credit supply. So the issue that everyone's worried about when they talk about all this money printing is what happens when the economy recovers and then the credit system recovers, and now there's more money in the system because we had all this money printing, and now we have all this extra credit, and so now we see the effects of inflation. So I don't know what's going to happen, but what I do know is the United States is the world's superpower, and as the world's superpower, it's really hard to destroy the dollar. Yeah, we can see the value of the dollar go down, but there's a lot of people out there saying that the dollar is going to collapse and that it's not going to exist anymore. But for that to happen, it's going to take a very extreme case, so I don't think we're there yet. So there's a lot of upside in the stock market, especially as we come out of this pandemic and the economy starts to open up. The question is, what is our economy going to look like when the economy fully opens back up? Are people going to have jobs or are they not? Are people going to be able to pay their mortgages or are they not? There's a lot of uncertainty that we don't know the answer to, and I cannot predict because I don't have a crystal ball, but these are things you want to pay attention to. But before I let you go, there's one more thing that I want you to be aware of when it comes to stock market crashes, because one indicator that has almost always been there in every stock market crash is looking for euphoria. Euphoria is when people get excited and they think that the stock market cannot come down, and so what do? They go and buy stocks without knowing what they're doing. And so this is when you have Uber drivers telling you stock tips like, oh my God, you gotta go buy this stock because I'm making so much money and it will never come down. When you start to get into that system where everybody's just throwing their money in the market and they're leveraging up their investments because they think that the stock market can never come down, that's when you hit that euphoria phase, and that's when you really want to start to get cautious, because nothing can go up straight up forever. And so if you start to see that euphoria happen, that's when you want to take a step back. But in general, the stock market has a lot of upside, and so we just got to be aware of what the potential triggers are, what to look out for, and what's going to happen in our economy when the economy opens back up. If you enjoyed this video, here's a video that I think you'll love, and while you're at it, subscribe to our YouTube channel and join our free finance and business newsletter. And as always, keep hustling. So if I want to make $12,000 a year and I can get a 3% dividend, that means I'm going to need $400,000 in my bank account to buy stocks so I can get my $1,000 passive income from dividends. I guess I'll pass.